Hello everyone and welcome to this week's FX update. My name is Craig Erlam, Senior Market Analyst at OANDA. As always, we'll start with a look at the economic calendar. It's been a bit of a slow week, if I'm perfectly honest. We have had some economic data out, things like the market, manufacturing and services PMIs from the Eurozone, which were quite well received. We've had things like the crude inventories, which Jeff will have touched on in his commodities video, which I highly recommend you check out. A GDP from the UK today, which was in line with expectations, although there was a little bit of a downbeat to it because we've seen that consumer spending added only 0.1% to this, having slowed, of course, due to this consumer squeeze as a result of higher inflation and lower wage growth, leading to negative real wage growth. Also, business investment actually remained unchanged on the quarter, so there seems to be less and less really providing that stimulus for the economy. Now, of course, the slowdown hasn't been as dramatic as a lot of people anticipated, but of course it still is much slower growth than what we were experiencing before, and I think we are likely to see that to continue to deteriorate gradually for a little bit longer still. Apart from that, the data-wise, it's been quite light. The event that people have been really waiting for this week is the Jackson Hole Symposium. Now, there is a piece on the Market Pulse website, which is where you can find this economic calendar. That's marketpulse.com. The economic calendar can be found just here. On the rest of the site is where we post our articles, and there is an article which I've written about the Jackson Hole Symposium, if you want to check that out. The real key aspect of the symposium, though, is going to be the speeches from Mario Draghi and Janet Yellen. Mario Draghi, of course, being the ECB president, Janet Yellen being the chair of the Federal Reserve. The reason why people are so focused on these is because these are likely to be two of the more active central banks over the next few months, or over the next 12 months really, but at least in the next few months we're expecting some activity from both. Mario Draghi, a member of the ECB, is, I think, unlikely to say anything. At the end of June, just to point out, he is due to speak at 7 p.m, as you can see on the economic calendar here. At the end of June, he accidentally gave the impression that the ECB was ready to start unwinding its quantitative easing program further, and this prompted quite a sharp spike in the euro. And it wasn't long before other officials within the ECB were coming out clarifying his comments because they were concerned about the movement in the currency. This is a central bank that's clearly very concerned about the strength of the euro at the moment, having climbed throughout this year, and about the strength of the government bond yields. And the reason why they're concerned about this is because they don't want unintentional tightening of financial conditions based on what they're saying. And I think because of this little scare that happened at the end of June, I think anything he's going to say tomorrow is going to be quite dull, and he's unlikely to give anything away. They're going to wait for the new macroeconomic projections in September, and they're going to carefully plan everything, every bit of information that gets out from there on in. So I expect little from Mario Draghi, but we should remain vigilant, because if we do get something, this is going to be occurring at a particularly liquid time for the markets. The other speech is Janet Yellen, as you can see here. She's due to speak at 4 p.m. Again, I should stress, these are GMT, so Draghi will be speaking at 8 p.m. BST, so that's UK time, and this is 4 p.m. GMT, so that's 5 p.m. UK time. Again, I don't think she's going to give too much away, but I think the thing that she is probably going to speak about more so is going to be balance sheet reduction. This is the thing that the Fed is likely to pursue from September. So that's next month. They're expected to announce that they're going to start reducing the balance sheet. The balance sheet at the Federal Reserve, which has primarily been built up from its quantitative easing program, 3 phases of it. They're expected to announce that they're going to start reducing it as of September. It currently stands at just below $4.5 trillion, so they're going to have some way to go to get back towards the kind of $2 trillion level that they want, that they think is far more suitable. The market's not really been too responsive to that at this stage. It'll be interesting to see if she gives more details on this tomorrow, if the market reacts. Again, I don't expect it. I think what the market really wants to know from Yellen is there going to be another rate hike this year? Is the pace of tightening going to be slower than they previously anticipated, or faster than the markets currently anticipate? And that is the thing where we're going to get the movement. Now, 2 major central bank speakers, I'd be very surprised if we don't get a lot of volatility, because even if they say little, markets always overly interpret tiny little things that they say. even if it's unintentional, and even if the actual meaning behind it is nothing. Markets always try to find a way to make it mean something. Excuse me. So I think these could be potentially quite volatile events. Moving on to next week, and again, the early part of the week is very slow. We've got very little economic data. Actually, the bulk of it comes from Japan in terms of the unemployment numbers, retail trade. It's the middle to the latter part of the week where it really does start to heat up, because it's at this point that we've got things like ADP employment change, and you know what that means? That means Friday is a jobs report day, the first Friday of the month, so it shouldn't really come as a surprise. We've got the non-farm payrolls here. On the Friday, the average hourly earnings, which is the one that I think is the most important, but people pay more attention to non-farm payrolls than the unemployment rate initially. Average hourly earnings is what we need to see. It's what the Fed wants to see. Higher earnings tend to lead to higher prices, and higher prices, of course, signals higher inflation. So that's what the Fed really wants to see. So this is the big event next week. Don't be surprised if we see a slower start to the week, and then it starts to build up towards the end. And also it's worth noting as well that while I say it's likely to be a slower start, we can never account for political and geopolitical events. So things that have, like the couple of weeks ago between US and North Korea, wasn't really easily foreseen, and Donald Trump is extremely unpredictable, as we saw last week, and he had a bit of a nightmare week last week, of course, with several committees being dissolved and losing key members of staff. In this case, it was Steve Bannon. There was talk about Gary Cohn, which was weighing on sentiment as well. So these unforeseeable things can happen. So even in these days when you're expecting very little, it can actually end up being quite volatile. But we do know that Wednesday, Thursday, Friday is likely to be far more interesting because of the sheer amount of data we've got. Now, like I say, we've got the inflation report hearing here on Wednesday, August 30th, apparently. I haven't seen anything again on the website, but we'll have to wait and see. Keep an eye on this because this can change. And then we've got things like GDP, of course, for the second quarter. This is the second estimate of GDP. EIA is always, the crude stocks is always important. This is the Fed's preferred measure of inflation, the core personal consumption expenditure price index. The year-on-year is the one to look at, and as you can see, it's now languishing at around 1.5%, well below the level that the Fed targets of 2%. And this is one of the reasons why people, including policymakers, I should stress, people like Robert Kaplan, are becoming concerned, because they were expecting inflation to have risen further by now, especially with unemployment at 4.3%. Personal spending and income is also some important data pieces here. We've got GDP from Canada. So needless to say, plenty of economic data to come next week on Wednesday, Thursday and Friday, so I expect things to be very volatile indeed. Moving on to the charts now. And we haven't really seen much change in the euro dollar this week. We have seen a little bit of fluctuations, but it's just been really choppy markets. I feel like traders are waiting for something more significant to happen. It has been a quiet week, both in terms of data, but also in terms of like political and geopolitical events. So we've just really traded sideways. So nothing's really changed here. We've got kind of 180 into the upside, just above. Just below, we seem to be catching some support around 117.50 and again at around 117. We did break below here a little bit previously, but that got bought into pretty quickly. It looks to me like consolidation at the minute, and if we look at the weekly chart, for example, this really does just look like consolidation in and around those 200 and 233-day simple moving averages. If I'm being honest, personally, right now, I'd expect to see a pop higher rather than a pop lower because of that, because consolidation does tend to be a trend continuation setup. But given the fact that we've got Mario Draghi and Janet Yellen speak this week, I hate to say it, but I'd say anything can happen. It really depends on what kind of message those two want to send, if any at all. Pound versus the dollar, we're hanging around this 128 level at the minute. We did break below the 61.8 fib eventually. 128 I always said was key, and we're hanging around these levels now. We're trying to push low, but we're still getting bought into it. Again, this still looks a little bearish for me. I want to see a close below 128, and if we can see that, then I think we could be looking back towards these kind of 126 levels here. We've got prior levels of support and also this confluence of moving averages as well. Should we pop high, then I want to see a new high being made before I start to feel in any way bullish, because for me this continues to look bearish at this moment in time. There's nothing in this chart which would suggest to me otherwise. We had a little rally today, but we immediately ran into resistance around this prior level of support from last week. So nothing about this chart looks particularly bullish to me at this moment in time. Euro sterling, we broke through that previous high. Now, you go back on the weekly chart, for example, in this case, because it's been so long since we've traded at these levels. We're now trading at the highest levels since 2009. That's 8 years. So obviously we're now, there's going to be a lot more talk about parity. I think you'll start to find over the next few months, because we've broken above the 90 level. Now there's a lot of resistance prior to this, so I wouldn't get too excited yet. 94 is the most notable first one. That's still far away from where we are now, so that suggests we could still see another couple of hundred pip moves higher. 95 above that you can see is notable resistance here and here, and then you've got 98 up here. Given that these are just, we haven't, it's been so long since we've traded at these levels, these are the levels which really do stand out to me at this moment. Now, you could see some resistance around here, I think, possibly, where we're currently trading actually around 92.40. That's because if we ran into resistance, you can just see here and also here. You've got to remember, this is a weekly chart, not a daily, so these aren't little tiny spikes. These are areas where the market has run up to these levels and then come back before going higher again, and here it's run up to this level again as it did there and then come back. So this will have been actually a little mini head and shoulders at the time. So really it's the 92.40s where we're seeing the shoulders, and that is where we're currently running in to resistance at this moment in time. So I wouldn't be surprised if we come back and test these previous resistance as newfound support. But really beyond that, I do think this is looking quite bullish at the moment. Aussie dollar, we're in consolidation territory as well. Again, we've just been choppy trading this week. There's been nothing that's materially changed here. One thing you'll notice is there's a lot of support levels on here, and I apologise for that, but if we look back at the charts, we are looking at levels which have previously been strong levels of support in this pair, so it's hard to really get past that. Let me just fix this chart right now. Yeah, so it's hard to move past that because you can see we've got resistance here and here, which we ran into previously, which we traded above, so that becomes support. Then just below this is a notable zone of resistance as well, so you can't just ignore these things. We had support on this level as well. So what I'm saying here is what we're looking at right now is consolidation, and it looks very much more clear on the weekly chart yet again. Let me just zoom out just to get more data here for the moving averages, but we've run into resistance basically around the 200-day simple moving average. And from here we've seen some consolidation. Now we're in an upward trend. This consolidation is very natural. I'm paying more attention to these consolidation lines. I'm looking at this and saying there's so much support below here, so I'm not going to predict the level. I'm not saying it's coming back to 78 or 78.50 or 77, whatever. At the moment, as far as I'm concerned, we're trading consolidation, and we're waiting for that confirmation to break through these the top of this consolidation phase, and from there, then we could be looking back towards, say, these 81.50s, 82s, where we've got prior resistance from here, but also the 233-day simple moving average coming into play as well. Now, of course, first barrier is always going to be the previous high, so that's around 80.50, but again, like I said, then it's 81.50 to 82. Dollar CAD, you can see on the weekly chart here, we were looking very bearish. We had a little bit of a retracement. We ran into support around the 200-week simple moving average here before consolidating, before seeing a bit of a correction. It wasn't an overly aggressive correction, but it was enough, I guess. And now we're starting to head lower. I'm waiting for a break here. The one thing I would say is that we are starting to see some support for the US dollar at the moment. So barring a particularly dovish Janet Yellen or a signal that we're not going to see another interest rate hike this year, I'm starting to wonder if the time has come for a bit of a bullish move in the US dollar. We'll have to wait and see because I want to see evidence of that. But the fact that the US dollar index is trading around that major support zone suggests to me that we may start to find buyers at the moment. The dollar CAD, on the other hand, like I say, there's no reason to be bullish. So even if we do see the dollar catching a bid, it doesn't mean that we can't see this pair go down, because the Canadian dollar could just catch a stronger bid. The central bank has already begun raising interest rates. It's expected to in many quarters one more time this year, and if so, that could be enough to drag it lower. At the moment, we're just kind of grinding lower. There's not really much momentum behind the move, as you can see, but really the next most notable level is around these kind of 124s, which is the previous low. Don't be surprised if we do go higher, though. I mean, if we go higher and we start to get towards these kind of 129s, 129.50s, you're hitting fib levels. that is just a retracement. It's a correction. These things do happen in healthy markets. I've said previously, ideally I'd love to see us get back towards a kind of 131 or at least 130, which is your prior zone of support. But beggars can't be choosers. We'll have to wait and see how that pans out. But there doesn't seem to be much momentum gathering to the downside at the moment. While we're on Canadian dollar, it's not a currency I normally touch on, but I did put a video out about sterling CAD the other day because the moves we saw were much nicer than the other pairs, because we saw weak pounds, we saw strong Canadian dollar off the back of some data which we'd had, and that took us through a very notable support zone, which had been a support zone since pretty much the start of the year. Things are now looking quite bearish. We have seen it continue with these moves lower. I'm still looking at these kind of 157.50s, 158s at the moment. I'm not seeing any reason to be bullish. We could be bullish into 162.50 at one point and see a correction and see look for confirmation of the breakout. But longer term, I think this continues to look bearish. New Zealand dollar, US dollar next. And the levels which we're talking about, which we talked about in the last video, we're still talking about now. I'm glad we've come back to this kind of 72 level. This is a big test as far as I'm concerned. We're looking at this now. It's prior support on a few occasions. It's a 50% retracement of the move from the lows to the highs. Should we rotate higher? We are seeing some consolidation right now. We are seeing a bit of a battle between bulls and bears. Should we rotate higher, then that could be a nice little move. Of course, the next test really is 73.30s. That's the previous high. A new higher high rather than a lower high would suggest that we've seen a change in trend. But like I said, it's a nice big test. If we break through here, then we're looking at these kind of 71.30s. You've got the confluence of the moving averages, and also you're looking at the 71s, which is the 61.8% retracement. Dollar yen, nothing much has changed. Consolidation throughout the week, so nothing's changed from last week's video. We're trading around the lows that we've highlighted in a number of videos now, around 108 to 108.80. The weekly chart shows why these lows are so important. I'll just zoom out so we can again get a little bit more data and stretch out those moving average bands. But look at that, the last few weeks, why has 108.80 been so important? Well, it's because it's the bottom of the Ichimoku cloud on the weekly chart. So that's why it's such an important support zone. A break through here and a close below here, things start to look very bearish indeed for the dollar yen pair. In sterling yen, we're seeing interesting levels also because we are trading back at the bottom of the cloud. We never broke above the cloud, so we're still in bearish territory here. But again, we are trading around the bottom of the cloud. Now, I've highlighted 140 as being an important level because it's psychological level. We've got moving averages. We've also got the 55 weekly moving average here as well, and then just below here around 138.75 we've got the bottom of the Ichimoku cloud as well. So while 140 is a real key level as far as I'm concerned, and we have broken below here already, I still think this continues to look bearish. We've broken the daily Ichimoku, we've broken all the moving averages and the lows. 138.50 below here is a big test because you've got the bottom of the weekly Ichimoku and you've also got that previous low here as well. So below 140, 138.50 is massive. Finally, euro yen. Again, we are seeing a little bit of consolidation. Now, this is the most bullish of the three because the euro is the clear outperformer. The weekly chart as well does give us some insight on the euro yen pair, because why did we run into resistance around 130, 130.50? Well, we've got the 200 and 233 day simple moving average band here on the weekly chart. So it would explain why we ran into some resistance there. I still think that we could see more upside, if I'm perfectly honest here. We are seeing some consolidation here back towards the kind of 128s, but I'm not really seeing any reason to be particularly bearish at this stage. Maybe if we see a break of these lows, or if we see a break of the Ichimoku cloud, then potentially. But I think people are generally more bullish the euro, barring any significant risk aversion. I think there is potentially a lot more, at least some more upside to come. Like I say, below here around the 126.50s, a break below here, and that would be a different story altogether. Thank you very much for joining us on this weekly FX update once again. Until next week, I hope you all have a fantastic trading week and a great weekend.